Stock markets surge after the long weekend break. There's a number of headlines driving them, but once again, the Federal Reserve has come into the purview. And the question is, do these buoyant markets care? That's what we're going to unpick here on Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And we're going to take a look at what these markets did here and try to figure out why they did it, and then look ahead because we do have some critical event risk now lining up in front of us. I'm going to try to see if we can make sense of what it means. So let's begin here with just a quick look at where the S&P 500 is here as we start the week. We can see last week things got a little bit soggy. We ran into resistance there just ahead of the 6,000 figure on this continuous contract for the S&P 500. That's right here. We can see essentially coming back in to test the underside of this narrower congestion range, the kind of last line of defense here on the way up to retest the year-to-date highs, and recoiled from there and headed lower. And you can see we actually extended quite a bit lower, or attempted to, on Friday, around the idea that U.S. President Donald Trump threatened to impose 50% tariffs on the European Union, ostensibly because the talks to reach some sort of a trade deal between the U.S. and the bloc were going, quote-unquote, nowhere. We'll recall that the tariff on the European Union that was announced as part of the so-called Liberation Day announcement that triggered this panic right here, that's been on pause since this decision by the president to put rates above 10% on ICE until early July 8th, 9th, give or take, depending on time zone, as it were. And since then, obviously, we've seen a blistering rally. Apparently, talks with the European Union were not progressing fast enough for the president's liking. And so he said that, never mind the pause, we're going to go to 50% tariffs by June 1st. And that seems to have been something of a forcing function, because over the weekend, the president apparently had an excellent phone call with Ursula von der Leyen, of the European Union, and we've now had a pause back to the status quo of the early July cliffhanger versus the early June one. In other words, Friday's tempest in a teapot was unwound. And so the markets find themselves booming here after Friday's sell-off, and essentially end up somewhat where they ended up midweek last week, as the rally stalled again just around the 6,000 figure. It certainly didn't hurt, and this is perhaps a little bit more substantive of a data point here, that the conference board came out with consumer confidence numbers that showed a potent rebound in May's numbers. Now, these are still sort of woeful numbers in relative terms. We're bouncing off some of the worst levels we've seen since COVID, so not exactly something to scream about, and certainly well below where we were last year, the year before, and even in 2022 amidst the early parts of the inflation scare. We can see that inflation scare peter out here mid-2022 as an influence on consumer confidence. Obviously, this is the inflation scare in its most pronounced. And then things anchor as the Fed's rate cuts, or rate hikes rather, start to work, and we start to get anchoring here, and things improve. So obviously, this is not exactly the best overall reading, but clearly that there was an improvement in these particular numbers, in May's numbers, and that it was consumer confidence that steadied. This is of course, a very welcome sign. And we can see that here, not only in the assessment of the present situation, where there's a mild uptick, but much more importantly, a sharp pickup in the setting for the expectations index. Now, this 80 line at the 80 level for this indicator, this is where a recession is still indicated. And the fact that we're still below it is not a happy sign at sort of face value. But nevertheless, the markets really liked seeing this, and for obvious reasons. And this is where you get into what seems to really drive the current situation. Now, looking back at first quarter GDP numbers, we're going to get a revision of them later this week. What we saw was a shock decline in GDP. It was down 0.3% year on year. That's this black line right here. And while there was, of course, a ton of focus on the front running of tariffs that gave us this massive surge in imports as well as in inventories, that's this jump in investment. This is business investment in inventory. That's the main driver of this. The real and most important takeaway here was the very small contribution from consumption. In fact, this was the smallest contribution in almost 2 years, going back to a reference point of the second quarter of 2023. And of course, the reason this is so vastly significant is that consumption is overwhelmingly the biggest contributor to economic growth. Breaking down GDP by components, we can see consumption is 68.5% of the total. So you really had to have these massive swings in imports and in inventories for those things to have a meaningful impact, because frankly, they're kind of an afterthought in the overall scheme of things when consumption is that dominant. In fact, when we take the difference between exports and imports, which is how we arrive at their net contribution to GDP, we arrive at something that's barely 5% of the overall total, which obviously is a much smaller influence, and you would need a 40-some+% swing in this contribution to get it to meaningfully alter the calculus. And so when you get a consumer confidence number that suggests this part of the equation is holding up, that's of course encouraging. Because if you were worried about the impact of tariffs on the economy, this would be the real world data that you would be looking at. To say that we've gone and arrived at a place that's a legitimate economic threat. And you can and this would be the hard data measure of seeing that. And of course, the first quarter in this sense was very troubling, because what I told you is that consumers are retrenching. Now, if we look at the University of Michigan version of the same data, it is quite a bit more scary. And this is perhaps because the cutoff on this survey is May 13th, and the cutoff on the consumer confidence survey from the conference board is May 19th. So the pause in tariffs, reciprocal tariffs on China, announced on May 12th, perhaps is much more pronounced in the conference board's numbers. There's a little bit more time for it to digest versus these numbers here. And we're going to get these numbers revised at the end of this week, so it'll be interesting to see which way those revisions go. But what we certainly see here is consumers are not of one view, depending on where you look. The University of Michigan would tell you that conditions are deteriorating. And of course, the weak retail sales numbers we saw for April would tell you a similar story. In that sense, this conference board data is, on the one hand, maybe a standout, maybe doesn't quite capture everything and is a little bit odd relative to everything else, but on the other hand, perhaps it is more recently biased and therefore more telling of what's actually going on. And so the story here becomes very interesting indeed, because if we're going to get this kind of seesaw on tariffs this, tariffs that, and ultimately we get ongoing evidence that every time one of these headlines emerges, it is a negotiating tactic and the baseline position remains a 10% tariff floor, which has been sustained in all of the deal making that we've seen so far and would amount to a 5-fold increase in the average tariff from 2%, then it is the consequence of that hard part of the equation and not the fuzz around the headlines that ultimately is going to show us what the markets need to see to properly price risk, and whether this bounce here is a pure sentiment reflection after people were biting their nails over the weekend, or if in fact this is a more lasting sort of thing. And for what it's worth, we have seen that in the data that we just saw in the PMI data update from S&P Global, there has been a little bit more of a reprieve, let us say. Now, the trend is still toward a significant slowdown around all of this commotion since the beginning of the year. We can see in the second half of last year, the U.S. economy was growing at some of the fastest that we'd seen since 2021. And as ever, these are PMIs that are centered around 50, where that's neutral. Above 50 is growth. Below 50 is contraction. The further you go below, the faster the contraction. The further you go above, the faster the expansion. And you can see here, not only do we have expansion for the composite index that takes in both manufacturing and services, which is about collectively 80-90% of the economy, but this is some of the fastest activity growth for this whole since back here of late 2021, early 2022. Since then, obviously, there's been a meaningful slowdown and where you've been flirting with standstill over recent months. But the May numbers were encouragingly a little bit more positive. Though as we dug into them last week, we saw that most of this seemed to be, again, inventory building. More front-running of tariffs, now with these new deadlines. Whereas employment remained in contraction territory, and most importantly, the prices influence on all of this has been surging. So, with this in mind, we turn to the event risk immediately in front of us. Because the question as to whether markets optimism is sentiment driven or if in fact the markets are shrugging off the economic consequences of increasing the cost of imports 5-fold, that question remains open, and for no one perhaps more so than the Fed, which is struggling to set policy in these circumstances. Now, we're going to get minutes in the next 24 hours from the Fed's May meeting, which took place on the 6th and 7th of May. And of course, by the time we get to the 6th and 7th of May, and this is the policy statement from that meeting, we can see that we've unclenched most of this decline. So we're somewhere over here when the Fed meets. We've rallied close to 19% off the low, and we've erased something on the order of 60% or so of this overall sell-off, which is obviously not a bad place to be. The markets have clearly improved here. They've clearly decided that this level of panic is untoward. But then when you look at the tone of the statement here, it is far from channeling the same perspective. Uncertainty around the economic outlook has increased further, the statement says. The committee judges that the risks of higher employment and higher inflation have risen. That is to say, there's been an adverse turn in risks to both sides of the Fed's mandate, and the risks are in conflict. That is to say, we are seeing that Fed officials are worried which way they're going to take rates, because they don't know if what they should be prioritizing is the risk of higher inflation and thereby keeping rates elevated, or prioritizing the risk of higher unemployment and speeding on rate cuts. And we can see that even going back to the March set of forecasts here, the last time the Fed updated its expectations, we can see December to March, we see lower growth expectations, higher unemployment expectations, higher inflation expectations. But the outlook for rates is unchanged. And the way the Fed justifies this when they meet, and what Fed Chair Powell explains at the press conference following the March meeting, and more tersely, as it were, following the May meeting, is the Fed just doesn't know. It knows that typically higher tariffs are inflationary and negative for growth, but it doesn't know how this particular episode is going to work out. And so with unemployment relatively low in the fours, and with inflation relatively anchored in the mid-twos, there's a sense that now is not the time to overreact. Now is not the time to do much of anything. Let's sit back and see what will happen. And that's an interesting perspective here, because, of course, we can see in the tone here, and it was much more readily apparent in the feisty display that Fed Chair Powell put on at the press conference, whether there is, in fact, something more here. Because clearly policy officials are not nearly as happy with what's going on as the markets are by this point. Clearly, they think that the situation is going in a worse direction, at least as far as uncertainty is, while the markets are clearly recovering and saying this is not as big of a deal as we feared. Now, as far as the Fed's forecast here, we can see they're looking at 50 basis points this year and next. If the current rate, we can see right here, is about 4.4, then what we're looking at here is from 4.4 to 3.9 is 50 basis points, and to 3.4, obviously, is 1% or 100 basis points. And if we take a look at the cumulative setup here, there's 44 basis points that's priced in for this year, so almost in line with what the Fed is thinking, a little bit light, and 52 for next year. So the market is a little bit shy of where the Fed is, but for the most part, these are rounding errors, and there's a little bit of lightness in this year's forecast. So 44 versus 50, the full 50 is there for next year, so you're about 5 basis points shy on the total, 95 versus 100. So the markets and the Fed are basically in line. And when you look at the current way that this is baked in here, you can see you don't really see a rate cut until you get into this September, November area. From here, basically through and into the fourth quarter here, you really don't see significant movement. The Fed is anchored, and as it happens, this is a much more hawkish setting than we'd seen since the beginning of the year. Now, the end point is a lot more aligned now than it was, let's say, in March. And of course, March 19th, we can see that's right here. So it makes sense why the market is much jumpier here than they were earlier in the year, and indeed now. But what you now see is a similar endpoint, a similar 50 basis points in cuts, but whereas at the beginning of the year they were going to be applied relatively smoothly, here there's this sense that the Fed is concerned about tariff inflation risk and so won't act. And so it's really interesting now to then consider, why is it that the Fed is so upset in May? What is it that they're seeing? Is this the usual disconnect between the markets and the Fed, where the markets are more volatile in their reaction function to the news, they're more jumpy, the Fed is more long view oriented and is concerned about the broader sweep of things? Is that why they're more so concerned and the markets less so? Or are they actually seeing something here that makes them worried about this? Are they actually seeing something that's more untoward? So in looking at these minutes, it'll be very interesting to see why Fed officials are concerned. What is it that got them to be more so combative in May than they were in March, when in fact the upshot of the story was about the same? And here, a look at the bond market is instructive. We can see the growth scare begin in mid-February. This is the S&P going down as that happens, and we can see inflation expectations go down with that scare, reflecting that the slowdown in the economy will overwhelm whatever upward price pressure there is from the tariffs. Essentially amounts to a call for recession risk. We can see that sentiment has recovered substantially. The break-even rates have not. They're still suggesting that the path of least resistance is still in the direction of economic weakness. They seem to have made up their mind. And if that starts to show up more acutely for Fed officials, well, then this might start looking like it's offsides. And the markets may well return to looking and watching for signs that the economic pain is arriving, this tariff headline or that notwithstanding. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after overtime. A little bit of a shorter week this week because of the holiday. I'm back here in just 30 minutes time, as I am every Tuesday, with Victor Jones for The Price of Truth, so come and tune in for that. I'll be on for Futures Power Hour as usual, Mondays and Fridays, Friday this week, writing for the News and Insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.